The new no tax on tips law, part of the One Big Beautiful Bill signed by President Trump on July 4, 2025, is indeed causing some confusion for the IRS and taxpayers. Here's a breakdown of the challenges and what we know so far. Key challenges and areas of confusion. The definition of tipped occupations. The law grants a tax deduction for tips received in an occupation which customarily and regularly receive tips on or before December 31, 2024. However, the law itself doesn't explicitly list these occupations. The Treasury Secretary is required to publish a list of qualifying occupations within 90 days of the law's enactment, which will be crucial for clarity. This ambiguity can lead to uncertainty for both workers and employers about who qualifies. For example, traditionally tipped roles like servers, bartenders, and hairstylists are likely in, but questions arise for other professions where tipping might be less conventional. Digital versus cash tips. The law states it applies to cash tips, which it broadly defines to include tips paid in cash, charged, and those received through tip-sharing arrangements. However, some interpretations suggest this might exclude tips received through peer-to-peer payment apps like Venmo or Cash App. Even though the IRS has historically treated all forms of tips as taxable income, this creates a disconnect between existing IRS guidance and the new law, potentially leading to confusion for workers who primarily receive digital tips. Reporting requirements and withholding. While the law introduces a deduction, it does not eliminate the requirement for workers to report all tips to their employers. Employers are still responsible for withholding federal income tax, Social Security, and Medicare taxes based on wages and reported tips. The deduction will be claimed by eligible workers when they file their tax returns, likely leading to a refund of withheld income taxes on those tips. This means workers may still see taxes withheld from their paychecks throughout the year on their tips, which will then be reconciled at tax time. IRS capacity. The news mentions that the IRS is already facing layoffs and funding cuts. This new law, with its need for detailed guidance, updated withholding tables, and potential for increased inquiries, adds another layer of complexity to an already strained agency. This could delay the issuance of clear instructions and increase the burden on taxpayers trying to comply. Temporary nature. The deduction for tips is temporary, set to apply for tax years 2025 through 2028. This limited time frame means the IRS will have to implement and then potentially unwind these changes within a few years. Adding to the administrative challenge. Income limitations. The deduction is capped at $25,000 per year and phases out for taxpayers with modified, adjusted gross income exceeding $150,000. This means not all tipped workers will benefit, and those with higher incomes will see a reduced benefit, requiring careful income tracking. What we know is clear: tips are still taxable income. The law provides a deduction, not an exclusion. Workers still need to report all tips, and they remain subject to Social Security and Medicare taxes. The deduction only applies to federal income tax. Employers still have reporting responsibilities. Employers must continue to collect and report tip information, withhold payroll taxes, and issue W-2 South that include reported tips. Guidance is expected. The IRS and Treasury Department are expected to release more detailed guidance to clarify the ambiguous aspects of the law. Workers are advised to wait for this guidance before making significant changes to their withholding or tax planning. In essence, while the no tax on tips law aims to provide financial relief to tipped workers, its hurried implementation and lack of initial clarity are creating a challenging environment for the IRS and potentially for taxpayers as the upcoming tax season approaches.